Я бы с удовольствием хотел представить вам нашего следующего выступающего, следующего преподавателя. Это Эллен Лауш. Он является одним из людей, непосредственно причастных к такому стандарту, как Risk Matrix, и он был в свое время вице-президентом Risk Matrix Group, одним из основателей Risk Matrix Group, и начиналось все это с банка JP Morgan. Если вы знаете первый value risk, то это практически стандарт, который был создан тогда, в то время, при участии нашего спикера. И Эллен рекордно долго добирался до Перми, поэтому мы перенесли его выступление на сегодня и дадим ему некоторую свободу рассказать о двух темах, о которых он хотел рассказать. Первая тема связана с интегрированным риск-менеджментом и управлением рисками в любой организации и в финансовой сфере, и не только. И вторая тема, связанная с больше финансовой, это стресс-тестирование и, точнее, даже такое адаптивное стресс-тестирование, подход, который в последнее время разрабатывает Эллен. So I welcome Эллен to start talk. И предлагается сделать так полчаса выступления по одному вопросу, и потом еще раз полчаса и вопросы. Мы можем немножко наш вечернее время венчания немножко изменить, если вы не против. Thank you.
Thank you, Sergey. Sure, why not? So I hope you can all hear me. It's great to be here in Russia, in Perm. So thank you for having me, Sergey, as well. Getting me to come out. I just told him that I've never flown so long in my life to go to a place that's a 1 hour time zone difference. Actually, it's quite amazing how close Bangkok and Paramount. So I'm going to talk about actually two modules, and if you could put the second presentation on, please. The adaptive stress testing. I'll start with the other one. So we're going to have two modules, each 35 minutes, and then we'll take some questions for each of them. And I'll start with adaptive stress testing. That's a framework for stress testing that I've been working on with some colleagues over some time. And the whole idea is how can we integrate stress testing with early warning. Right? The module is divided by three major parts. First, what's the framework for adaptive stress testing? What do we need? Then second, this is the fun part, how can we determine if something is signal or noise? Right? That's been a discussion quite a lot today and I'm sure yesterday as well. So what are some mechanisms for signal detection that we're actually dealing with something that should warrant our attention? Or are we just reacting to noise? Right? That's that fundamental question. And then I'm going to talk about stress rates, which is one of these early warning metrics that we put in place. And then there'll be a conclusion. Okay. So this is a chart from infamous. It's kind of a bubble chart, and every day you can get updates on that. The Economist has that. You can filter it. And what's interesting is you can see sort of as world news. This is from this morning, right? So there's a tsunami. And it sort of just filters the news to look at what are these themes. And you can see that there are themes that are emerging, that are large, then there are others that are small, that become larger, newer bubbles come. And so the whole idea is around stress testing, that we need really multiple intelligences, right, to bring something together, right? So let's say, for example, that there's unrest in the Middle East, right? Let's say it's in Iran. We will need to get people to have an understanding of the situation there to see how will that affect the various regional economies, companies, and so on and so forth. So the whole idea is we have to find some way to deal with, one, emerging scenarios, and two, to figure out how do we integrate different perspectives. Okay, and these are interdisciplinary perspectives. Right? one of the implications of complexity really is that the world is just too dynamic and too complex that the standard way of predict and control simply doesn't work, right? We cannot make long-term predictions, a 5-year business plan, and just go according to plans. There's nothing wrong with making a 5-year business plan, right? But essentially the world has become so fast and so dynamic that new themes are emerging all the time. There are too many non-linearities, right? And so the paradigm is shifting from predict and control, top-down, right, to much more of a sense and respond, right? So you might view mountain biking as that, right? So you can look at predict and control, right? Sure, you want to look at the course beforehand, the map, get the GPS information, right? You want to control what equipment you have. You do as much as you can, right? But when you're in the mountain race, of course, right? Whether it's rained or not, and the immediate conditions, you're going to have to sense and respond using essentially dynamic steering with continuous feedback, right? So that's the paradigm that I'm going to talk about. How can we use risk management in a very adaptive way to go from a predict and control to a sense and respond paradigm? Okay. So the first step, of course, is to look at structural risks, right? That's the top-down perspective. Okay. Thank you. And this is a picture of essentially earthquake activities, right? Correlated to essentially fault lines. And so you can see some hotspots there. And what's quite interesting is if you look at hotspots, there's some fairly red areas there, and the dots here are nuclear power plants, right? And of course, the frightening thing is that you can see a lot of the dots in Japan, which is an earthquake fault hotspot, right? So essentially, we've got a structural risk there. We have both a lot of seismic activity, right, as well as nuclear power plants. So that's understanding structural risk. Then you want to look at how your portfolio is positioned relative to those fault lines. So let's say that you understand that there's a fault line, San Andreas Fault in California, right? If I'm going to build a house, I want to know where I am relative to the San Andreas Fault, or kind of a bedrock, right? Is it going to be a concrete building, tall concrete building, or a little wood building? So that's kind of the analogy. There's systemic fault lines, macro, and then there's micro, how you're positioned relative to those fault lines. Are you very vulnerable, right? Are you a nuclear plant on top of the fault line in Japan, or are you located somewhere else? Okay. One of the major challenges, of course, is that people have that disaster myopia. There's a great paper by Andrew Haldane from the FSA in the UK. One of the, this one is why banks fail the stress test. One of the issues is that people are incredibly short-sighted. There's this exponential decay in our memory, right? We only view, as you saw in the previous talk as well, that a lot of market shocks, a lot of models are built on really looking at short-term data. We forget the impact of long-term data. So that would have helped in the earthquake, right? It was Fukushima was located in an earthquake and a tsunami zone, and both of that historical data would have uncovered. So that's an understanding of structural risk, right? Looking beyond the visible risk, the short-term risk that you see on a day-to-day basis, but looking at macro, structural, long-term risk. That's the first part. Okay. And that's this macro risk. Identify the fault lines, right? These are the potential risks that are invisible. And then we have the second thing, which we focus on a lot, which is these are the visible risks that we see in the bottom up. Okay. So that would be that would be micro, right? So that's the overall approach, the framework that I want to propose for adaptive stress testing, is that we take both a top-down view, where we consider potential risks, structural risks, invisible risks, risks that we do not see, right? You can walk around and it's not apparent if you're in a fault line, on a fault line or not, right? This is hidden. It's not apparent if you're in an earthquake zone or not. That's a hidden structural risk, right? And so the key is to uncover those, right? And then at the same time, we need to focus on the tremors, the visible risks, what we see in the market, the signals that that the marketplace is giving us, and these signals that we're able to now gather so well using mechanisms, as we talked about earlier with the high-frequency trading. There's a lot of data and data processing and synchronization going on, where we can learn tremendously, right, from what really is a cloud computer, right? The marketplace is a distributed cloud computer of information, right? So there's tremendous information in terms of visible risk, okay? And we need to pair that with this perspective of invisible potential risk, right? So that's that overall framework. And of course, they feed back each other all the time, right? So, you know, if you look at the fact that there is a tremor in the San Andreas Fault, right, in a particular area, then you pay more attention to that particular fault line, right? So, you know, in other words, if there's, you know, if one of your scenarios is an agflation, right, agricultural spike in inflation, and then you see a spike in wheat prices, right, that will make you pay more attention to that fault line. So the second part of this framework here, I've gotten from really epidemiology, and this what is called here the technology adoption life cycle. Okay, this comes from a book, Jeffrey Moore's Crossing the Chasm, and what he talks about there is technology, how new technology gets adopted. Right, there's a pioneers who invent new technology. Let's say there's Mark Zuckerberg, you know, creating Facebook in his dorm room at Harvard. You know, when he was doing that, there were 10 other social networks. You know, some at universities, some established companies, right? And some had started to take off already, and that's this concept of the chasm, right? To go from innovator to the early adopters, when that happens, right, then you know there's something unusual that's going on, right? And he calls it crossing the chasm because most ideas, right, for every Mark Zuckerberg, right, there are 1,000 people who thought about that idea. Of those 1,000 people, maybe 100 people decided to write something down and, you know, think about it. And maybe out of those 100 people, 10, right, actually went and did it, right? So there are 1,000 of these people who are there already, right? The question is, which one's going to make it, right? Who's actually going to create this social epidemic, right? There are thousands of fashion designers, right? What's going to be popular with the kids, right? And so what they found in not just technology, but fashion and everything else, that there are certain groups of people who are early adopters, right? And they found this first in looking at which farmers bought the newest kind of grain, right? They were always, the grain companies, they were pioneers, they were always coming up with new seeds. And they recognized that a seed was likely to be successful if the early adopters started ordering a lot of those seeds. And then the early adopters, the early majority, then watch just to see what the early adopters are doing, right? So right now, for example, you know, the iPhone 5 was launched, right? And everyone's watching, you know, how many people are jumping on. At the same time, Windows 8 came, right? So, you know, is Windows 8 going to jump that chasm? Are they going to get that critical mass? Because the early majority, you know, is only going to upgrade from Windows Vista, whatever they're on, if they see that that really becomes a standard, right? So the key thing here, from a stress testing perspective, is that there's a critical point, right? This chasm that needs to be crossed. If that chasm is crossed, then we know we have a signal. We have essentially a self-amplifying process. Okay? So this is what I propose for building a stress library, right? That you have a stress library where you look at some pioneers. Pioneers might be someone like Nouriel Roubini, who's coming up with various scenarios. David Rosenberg, who was the Merrill Lynch economist, who was quite bearish on markets before they collapsed during the subprime crisis. You come up with a group of thought leaders that come up with scenarios. But Nouriel Roubini, for example, one of his NYU professor colleagues was complaining, oh, he's been talking about this for years. Even a clock that's stuck, is going to be right twice a day, right? So, the point is that pioneers, there are a lot of pioneers, they have a lot of ideas, but this is not someone, Nouriel Roubini is not someone who's in the market looking at, price movements on a day-to-day basis and saying that, now the financial crisis is going to begin. So the key thing is you come up with these this stress scenario for these innovators, but those are the potential risks. Those are the invisible risks. Those are people who see certain fault lines, right? But it doesn't mean because someone says, oh, there's a major fault line here, these particular countries are vulnerable, that fault line, there's going to be an earthquake, right? So the second part is then looking at early adopters as early warning signals, right? So an early adopter might be, Goldman Sachs or Paulson Hedge Fund deciding to short subprime securities, for example. That's what happened in the United States, and so you can monitor what the early adopters are doing, but how are you going to get that information, right? They're not going to tell you that they're shorting subprime securities. You're going to get that from this bottom-up visible risk perspective, right? There are going to be tremors in the marketplace. If someone like Goldman Sachs is selling a particular security, there will be signals, and we'll look at what those signals look like, right? So we look at what are the potential risks, the macro risks, the fault lines, and then we monitor which ones of those is actually taking off, right? So the innovators, Roubini, Rosenberg, Schiller, Rogoff, Reinhardt, Ferguson, all those guys, gave early warning on some kind of a subprime global financial crisis, and then there are these early adoption signals. First there's an outlier, right? That's the first signal, right? And then there's a spike in volatility, super exponential rate of change. The second book by Jeffrey Moore was called Inside the Tornado, because that's what it feels like if you're in a startup company, right? And you're crossing the chasm. It feels like you're being lifted up by a tornado. There's such a huge force and a huge volatility. That's when you can tell, right, when you have growth rates, tremendous, huge rates of change, that growth has now become self-amplifying. It is now like a forest fire that has started to burn, right? This is now an avalanche that has started to come down. It's amplifying itself by its own force. So those are the signals that we want to look out for. Okay. So as an example here, Nouriel Roubini was talking about this, how vulnerable the financials were, right? Way before when markets were very, very calm, right? Risk was still invisible back then, right? It was potential risk. I heard him talk at a conference in Hong Kong, sort of everyone smiled politely at his doomsday scenario, and then, kind of changed the subject, right? Because what he was talking about was invisible. He was talking about a fault line that people didn't think existed, and then the first signal here was in the equity markets was this outlier, February 27th, 2007, right? And that first outlier, we'll focus on that a little bit more, what that came from. That was actually subprime related. But what I want you to focus on here is this is that pattern of endogenous risk, right? There is this risk which is in its potential form here, right? The risk is there, right? This is 2006. The risk was there. All of those excesses in subprime were there, right? The huge leverage of financial institutions, the bad loans that were being made, that was all there, right? But that risk was invisible to the marketplace, right? And so the first lesson is that the time, what to focus on when the markets are calm. When the markets are calm, it doesn't mean there's no risk there. Actually, it means that the risk is not hidden, right? That's the key thing, that you should be very careful, right? And you should use that time when volatility is low to search for what those potential risks are that are hidden, right? And then that risk manifested itself first in the markets as some outlier movements. First in subprime securities in December 2006, and then that infected the equity markets in late February 2007. And it was still viewed, by the way, as an outlier event, because after that February spike, it came after HSBC announced a $10.5 billion loss in subprime securities. Equity markets fell quite substantially around the world. China was down 3.5% as well. But then it recovered, right? So from February to October of 2007, the markets actually peaked in October. The broad market, the S&P 500, right? So that information, that signal came out, right? But by the way, financials had already peaked by then. Financials had their peak on Feb 27. That was the peak of financials. They have not been up to that level yet, right? So they started to diverge, but the perception was that the broader equity markets are not yet susceptible. And so it only started getting more serious sort of towards the end of 2007, spiked more and more, and then came Lehman, and then all hell broke loose, right? So this is a perfect pattern of, there's some shock to the system. The system was very vulnerable, right? And that volatility kept amplifying throughout and shaking the system down. And so what happened then was, at this point in time, you would have seen, if you track financials and volatility, using this adaptive stress library, you would have seen, oh, now this Nouriel Roubini scenario that he's been talking about for 2 years finally shows, like, actually the risk has gone from invisible to visible, okay? So that's the overall process, and then it goes in reverse. You can also see how, as volatility declines, markets are then recovering, and that theme then is no longer relevant. So the key lesson here really is, though, that I want you to remember this concept of potential risk in its potential form and risk in its visible form. Just because this period here was the riskiest period for long-term investors to invest, right? That was like, the visible risk was tiny, right? But if you had invested in financials or in stocks or in subprime bonds, that was actually the riskiest time period. And the least risky investment for you would have been to invest here, when the volatility was the highest. When the market is saying that this is the riskiest, actually, at that point in time, actually, the situation was most of the risk that was in the market was in its visible form, and there was much less in its invisible form, right? So what's more dangerous? Would you rather be in a situation where you walk into a room and the risk is invisible, right? Or would you rather be in a situation where there's a lot of risk, but it's visible, right? So that should bring us to talk about contrarian investment strategies. Okay, so moving on, another perspective here, a whole concept I would like to underline here is, we have this phase transition process that happens when we go into financial crises. But a lot happens before that phase transition actually occurs, right? There is that exponentials grow very, very slowly, right? But once they hit critical mass, the amount of control that you have is very little, right? So typically, this is from actually a reputation risk framework. Typically, there's some kind of a event that affects the reputation of the company, right? And if the company were to address that immediately, right? Say JP Morgan's, London whale test, problem, as opposed to say dismiss it, oh, it's a tempest in a teacup. There's actually more of an ability to control a situation in the beginning. Once you wait for that risk to increase and increase and increase and amplify it, it's hit self-amplification there. Your level of control goes down and down. So you only have control here when the risk is in its potential form, right? Once the risk is in its visible form and hit that tipping point threshold, you lose a huge amount of control. So same story again. The risk here was in potential, invisible form. Okay. And then what are the early warnings that you're about to hit a phase transition? Well, the first is that there will be some kind of an outlier, right, which is not shown on this graph, right? So, and for every outlier, you always have to then ask, is this signal or noise, right? When we were, overlooking risk at JP Morgan, whenever there was a 95% confidence outlier, we would look at, okay, you know what? Is this just that once in a month, once in 20 days, random event that just happened, right? Is it noise? Or is it signal, right? We get everyone in the room together, right? And then if that once in 20 event happened, that outlier happened on Monday, and then another one happened on Tuesday, and another happened on Wednesday, each day we would get more, confidence that, you know what, maybe this is not just noise, maybe this is a signal, right? So that's the first thing. But the second thing is, exponentials are very hard to detect when you start to go from no trend to a trend. In the beginning, right, it looks like, okay, you know what, it's just a linear process. But what you notice is that basically for exponentials, it's non-linear, right? Whatever linear approximations will not account for the non-linear rate of change. So that means amplification mechanisms have been triggered, right? Now you've got a snowball that's getting bigger and bigger and bigger. Okay. All right. So that's the framework. Now, signal or noise. Okay. So I have endogenous and exogenous crises here. So everyone knows about black swans. Extreme events. They can't be predicted, can't be forecast, not so solid. And lots of examples there. Then there's, Didier Sonnet's Dragon King. Many of you would have maybe heard his talk here 3 years ago, right? He holds that financial crises are largely, the majority of financial crises can be quantified and predicted to a degree, right? There are many examples of that as well. And the real mechanism by which this happens is typically there is a structural risk, right? It might be a forest fire or avalanche. There's some kind of a risky situation, risky structure, and then you have a precipitating event, right? And if the structural risk is there, then these events amplify, right? So that's the key thing. That in this Dragon King theory, right, there are some, the theory holds that some very small shocks, when put into a structure which is vulnerable, will then amplify into very, very large shocks, right? So this Dragon King actually starts off as a little baby outlier, right? And then that baby outlier grows into a big dragon, as opposed to the theory that, oh, this big swan flies through, right? So in earthquakes, you have similar things, right? You have some earthquakes, like, we're pretty bad at predicting earthquakes, actually, right? But we have noticed that if you have more seismic activity, actually there's a chance, right, that there'll be greater chance of big earthquakes. We still don't know when exactly, but if we see that spike, and this is what Sonnet shows here, right? And there's some seismic activity that's increasing and increasing, you can have a situation where many small earthquakes amplify to a big earthquake, right? Interestingly, he shows a micro pattern of that as well in brain seizures, similar process. But every once in a while, it's just a black swan. Every once in a while, you just have a big earthquake and come. It doesn't mean that black swans don't exist, right? There are black swans. There are unforecastable extreme events, right? They can be severe, but not all of them. And certainly in terms of a large financial crisis, right? Typically, there is some endogenous vulnerability that's in the system. Now, of course, the financial system is always endogenously vulnerable because, the banking system essentially is based on a leveraged mismatch of liquidity, right? Deposits that can be withdrawn immediately and loans that are held long term. So the system is going to be vulnerable by definition. There are always going to be some structural risks. Okay, so this is back to subprime here. So the first signal here, this is when Goldman Sachs got out. They saw that there was basically there are 9 days when their value at risk models basically had no relationship to the risk in their subprime bonds, right? And the amount of losses were tiny. Who has an idea here what AAA rated subprime bonds were trading at above treasuries? How many basis points would you guess before the crisis? 15 actually. Yeah, that low, 15 basis points. So these were considered risk-free, essentially. 15 basis points, right? Which means for 5-year security, over a 5-year period, you would have gotten 0.75% of return accrued. And that the first spike was small. So the volatility in these securities was tiny, 1 to 2 basis points of volatility. But that volatility went from 1 to 2 basis points to 3 to 5 basis points. Okay, so it about tripled, right? So not a big deal, right? And actually, but Goldman took attention. They paid attention because what they do is they look at their risk models and their value of risk very, very closely, right? And they'll tell you, you know what, our models, they're not the best, actually. But that's actually, you know, what we pay attention to is revaluation, right? And we look at when our VAR models don't match reality, and then we believe reality, right? Then we believe the market. So they, you know, so even though the losses were tiny, they decided to sell their securities after these 9 days of outlier. Okay, get up and see. The market then tightened, went up to 25 basis points or so, then tightened back to 17 basis points. The market forgot about the shock. The market said that was just noise, right? And then you had a spike, a bigger spike. This time, this was after the HSBC loss announcement of $10.5 billion in their subprime. Spread spiked from 15 basis points to about 35 basis points. That's another 300 basis points. 300 times spike in volatility. Again, the absolute volatility is really small. If you'd held that security and you've gotten a bank statement every day, every month, or every day even, you wouldn't have noticed a big price change. It's just if you know, just like you wouldn't notice the tremors from small seismic activity unless you have a seismograph, right? So you really have to look where you're looking. Interestingly, the market shook that off, and from 35 basis points, it tightened back down to below 20 basis points, you know, until the summer of 2007, when you know, basically here the Bear Stearns hedge funds had shut down, and then Merrill Lynch tried to sell off all the collateral that they held on their books themselves. And then the rating agencies woke up and said, oh, maybe these aren't really AAA rated securities. And then the market sold off, right? So you can see the biggest signals from a relative perspective came before the actual financial crisis, and the market ignored it, completely ignored it, right? The market as a whole, but not the early adopters, right? That's the key thing, right? Where is their information in the market? Can we just look at the market as a whole? I'm saying no. Look at the early adopters. Don't look at the whole market, right? You know, the market on average might be efficient, you know, depending on what your definition of efficient is, right? But you can segment the market. You can get more information from that. Okay, this is just on an absolute basis, right? So this tremor is so small you can't tell that first tremor, and then that was a little tiny tremor. Spreads went right back down, and then you can see these, you know, these big waves continue, right? So again, but that risk was there here. That low volatility did not correspond to low risk. Again, that was the highest risk time period for anyone to invest in these kinds of securities, when the visible risk was zero, essentially. This is just the same thing for the Dow. You know, you can see that very low volatility in the Dow, and then a 3.5% drop in the Dow, which is tiny. But we looked at the top 10 surprises in the equity market. This was the 6th biggest surprise in the equity markets in 100 years, right? A 3.5% drop, very small, right? You know what the biggest surprise was? Do you think it was the '87 stock market crash? Right? That was the biggest move. That was not the biggest surprise. The biggest surprise was the Eisenhower heart attack, right? When volatility was very, very low, and there was a relatively small movement in the equity prices. So it's relative to how large volatility is, right? And that was a black swan, that big surprise, right? And then here, I would say that was the Dragon King. That was our Dragon King baby, blocked out, you know. And then from there, you can see that, you know, you get this amplifying process of volatility that we saw with financials as well. Okay. Right. So let's move on to stress grades. And here, essentially, you know, I was talking to a bank risk manager, and you know, she was telling me she works with one of the large U.S. financial institutions, and working over their hedge fund risks, right? And so they have all these different hedge fund counterparties, and you know, they run 182 scenarios, right? But she said it generates a lot of information, right? But we don't know what to do with it, right? What are the right scenarios to look at? The scenarios where we lose the most, right? But maybe it's the scenarios where we lose a moderate amount, right? Where, you know, which is more likely to happen, right? So, so I thought about this framework here, right? Where you look at essentially a stress event according to a Merton framework, right? So you have, you know, I think you're all familiar with Merton models, right? So you have a, you know, essentially you have an asset with you know, distribution, volatility, and you have a specific threshold. So Merton credit models are, you know, the threshold is where the liabilities of the company is, and so you look at the volatility, right, of the asset, and calculate the probability of default, right, through looking at the probability of you hitting that threshold. Well, we can, you know, Merton doesn't just apply to credit. You can apply Merton to any stress scenarios, whether it's a company defaulting or the S&P dropping by 10%, right, or the S&P dropping by 10% and oil spiking up by 20%. That can be looked as basically you have some kind of a distribution. In that case, you know, maybe 2-factor, 3-factor. It doesn't matter how many assets. That distribution has some volatility. There's a critical point that you want to measure, and there's volatility that's driving that, right? You measure use historical volatility, option implied volatility, right? So it's using all existing building blocks, right? And the metrics here I've just used here is distance to stress and standard deviations, right? So in this case, this threshold might be a 2.3 standard deviation distance to stress, and then there's the probability of that stress happening, right? And then there's also a stress Q, or the quantile. Are you at a 99%, you know, sort of quantile, or are you closer to, say, a 50% quantile? So I wanted to backtest this like this. I decided, okay, I'm going to pretend you know, I knew what happened in the financial markets. Right? The biggest drop in the S&P 500 was a drop of 9.6%, 1st of December 2008. And I wanted to say, well, I'll set that as that threshold, right? So as a threshold, I decided, okay, I'm going to make this threshold a drop of 9.6% in the S&P 500, and I'll see if there's any early warning indicator, right, that as we get closer to the point when it actually happened, right, to see if the probability of that event occurring increased or didn't increase, right? So this is, first of all, the distance to stress, right? So when this first happened, basically, the probability of you having an event, 9.6% drop was basically anywhere between 15 to 20 standard deviations. At the low, it was close to 24 standard deviations, right? Then as we, you know, as these early warnings came in, February, it went from basically 24 standard deviations to 10 standard deviations, right? It became much more likely. Then the distance grew a little bit more, and then, you know, basically we went from 15 standard deviations to, right before this happened, the magnitude of 9.6% loss would have corresponded to only a 2 standard deviation event, right? So we had basically something that shouldn't happen once in the age of the universe to something that should happen, you know, basically once in 100 days, right? this is expressed in terms of P stress, so probability of stress, right? So, so here basically, you see the spike. This scale that you see here, right? This is a logarithmic scale, right? So every time, right, there's a tenfold increase, right? So you can see that, you know, just using a normal distribution assumption, which obviously is a great distribution to use here. So we're experimenting with extreme value distributions and other things as well. But using a normal but again, the point here is not to predict, right? That, you know, we know that the probability of this happening is 0.00152%. I want to sense and respond. I want to know that something very unusual is going on, right? So when there's that spike, basically, on that one day, there was 170 times that. After February 27th, the chance of 9.6% drop in the S&P 500 escalated by 170-fold, right? Okay, was that just noise or signal? I don't know, right? It's a pretty big signal, right? But it could have just been noise, right? And then looking at this trend, right? You can see the trend, it looks like a linear trend, but again, this is a logarithmic scale, so the probability went up. After that spike, went up by another 1,300% as an implied volatility, right? So it was very clear if you just looked at and this is volatility. There's nothing fancy about this, right? The model is not predictive, right? What we're saying is there was information in the market. Volatility contained valuable information, right? We're not predicting anything. We're simply translating volatility into a probability metric. This is what the market was implying, basically, right? And you know, you can use this with VAR bands as well. This kind of technology, as I mentioned, when you look at outlier clustering and things like that. This is looking at various ETFs, you know, things like financials, interest rates, gold, things like that. So what's interesting is you saw this, you know, sort of broad. This is a logarithmic chart. So a linear change is actually, you know, it's actually tenfold. Each of these bands implies a tenfold increase, right? So you can see that, you know, you can see sort of when, you know, gold or inflation risk started to take off. First it was financials that took off, right? And then, you know, and then people thought, okay, you know what? The risk of deflation increases, so the deflation theme escalated. And then people thought, oh, maybe not deflation, maybe inflation, right? And both, right? So then that escalated, right? And then at the peak of the crisis, right? You know, what's interesting is like you had these were, you know, trading in pretty wide bands. Everything converged, as in like, wow, there's a lot of volatility, right? And then that volatility declined pretty much in lockstep, right, together. And that was a signal that the markets were recovering. So I'll say this, the spike in volatility came before, right, the major drop in the markets, right? It preceded the bear market, right? The spike in volatility in one day corresponds with a drop in one day, typically, right? That's when usually, so, you know, I'm not saying that the spike in volatility will forecast that tomorrow the market will go down, but in this case, the general spike in volatility preceded the bear market, and also, at this point, the volatility is the highest, right? The market is saying this is the riskiest time. When we go from the highest to just very, 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 very high, right? Still, the market, you know, is starting to recover a little bit, but basically what's happening there is that the coordinated decline in volatility preceded the bottom of the market. The market was still bottoming out, right? And then as that trend became clear, that established the bottom, right? So again, a big argument for contrarian in investment strategies, right? Here, basically, you know, visible risk was extremely high and then going down. And that was the turning point in equity. So how might you use that early warning? Well, you could look at stress grades, right? And you know, and then the change in stress grade and say, you know what? I want to look at the high risk scenarios that are escalating the most first. And then I want to look at the other scenarios, which might be low-risk scenarios, but are escalating. This would be might be subprime bonds, AAA-rated subprime bonds in December 2006, where the absolute volatility was tiny, but the move was very, very high. And then you start, out of all those, say, 182 scenarios that you're monitoring, you then figure out, well, what do you look at? You want to look at the risks that are large and increasing first, right? That's your first priority. And then you want to look at the risks that are small but increasing a lot as well. Okay. You want to do things like basically outlier analysis, right? Signal whenever there's an outlier, right? Is that a signal noise? That's a discussion you want to have. Okay. And you might this is just a sample graph. This is not actually outlier movements, but you might want to actually plot outlier activity across time to see, do we have something systemic going on, okay? And then you want to look at network graphs as well, right? This is from FNA.fi. Sergey knows them very well as well. You can actually, by looking at how these networks change, right? You can actually detect when there's unusual activity, right? For example, looking at the Lehman crisis, right? We went from a network which was very broadly distributed to then everything clumps together, right? All the risks become coupled, right? Tightly together, and then the network slowly kind of expanded. So it's interesting to obviously look at the shape of the network, what's at the center of the network, and things like that. So again, it's part of this sense and respond, where we want to get sensory information of what is actually, what are important changes in the markets to be able to make an assessment whether that's a signal or noise. Okay. So, I think there's a lot of, the potential for using visualization and algorithms to detect signals amidst noise. You want to prioritize the attention to the relevant fault lines and specific portfolio vulnerabilities. Right? Here's a quote. Most of the focus in most companies is on what's directly ahead. The leaders lack peripheral vision. This can leave your company vulnerable to rivals who detect and act on ambiguous signals. Right? So subprime in 2006 was a peripheral issue. Right? It might have been there, but it's only if you, if you really expand your view, and that's what we can use bottom-up analysis with it. It really can expand our peripheral vision. But we don't want to just monitor tons and tons of data and get confused by it. Right? Confused by that. So the key is always how do you filter the noise out of the signal. Okay. So to conclude, you want to build an architecture to adapt essentially to market intelligence. Okay. Focus on use market signals to focus on relevant fault lines, and apply more severe probabilities as well as scenarios. Proactive response is essential, right? That curve of control that you saw that decreases. Okay. I think there's a lot of potential for war games, for actually going through and simulating these throughout these scenarios with other people in your team, so that when you actually face a crisis, that there is that you've played that game before. It doesn't stress you out. It's not the first time you're holding a gun, right? And that's, I think, what happened to a lot of risk managers, right? And then take advantage of calm periods. Remember, it's calm period, low risk period or not. It's a low visible risk period. The calm period can very well be an incredibly risky period. And take advantage of that to look at your concentration risks. Where are you positioned relative to your fault lines, right? And it was clear if the companies who did that before the financial crisis fared much better. Okay. So adaptive stress testing practices are based on the basic concept of evolution, right? So you want to experiment, right? Explore emerging vulnerabilities, seek to uncover stress concentrations, right? You want to experiment, then you want to learn from that. You want to have feedback loops, right? That's the key thing. There's a great book that I would recommend everyone to read. It's called Adapt by Tim Harford. And one of the quotes that I like the best is, it's not about creating a world with better solutions, right? Because a solution will always be outdated at some point in time, right? It's it's building a better world where there are better feedback loops, right? Which you can learn from, right? How can you build those feedback loops and learn? And then practice, right? That's evolution. Experiment, right? Experiment, play, try different things, right? Learn from that, and practice. That's what a child does, right? These are like lessons from from childhood on better risk management. Obviously, early detection and adaptation is crucial. And stress grades will help harness market intelligence, which just exists in the form of volatility. Right? Okay, so thank you. So that's first. Let's see. Does anyone have any questions?
Thank you so much. It was extremely interesting to hear you and your presentation. I would like to ask you a question as a market risk manager. We, with my colleagues, recently thought about the fact that if our VAR is decreasing, it doesn't mean that the risk is decreasing. The idea that you discussed so greatly now. And when this thought came to us, we thought about what we should limit, because we have the VAR limit in our bank, and we limit the VAR. And we thought, if VAR if VAR doesn't always show the real risk level, should we limit the VAR itself, or we should limit maybe the stress value of it? What is your opinion?
This is we went through the exact same thing at JP Morgan. We started off with VAR, DEAR, and then all limits were based on DEAR, and then we realized how exactly that, and so we became dual limits. There are stress limits as well. We apply, there's a stress limit and a VAR limit, right? So if it meets either one of those, you basically want to reduce your risk.
And what is the ratio between the limits? What is the ratio between, if we divide your VAR stress limits by the VAR normal limit? What is the ratio?
Well, I don't think there's there's not really sort of a fixed relationship. I mean, there are some short-term extreme scenarios that we would consider, and some longer-term extreme scenarios. But at JP Morgan, the number that people paid a lot of attention to was basically stress losses that would be in excess of the VAR of the total firm. Right? So any individual firm, desk, or we have any positions on, however we slice it, that could result in a loss larger than the entire firm's VAR limit. Right? That's what we use as a benchmark to reverse engineer our reverse stress testing.
Okay.
Right?
Okay.
But there's no fixed, sort of. Yeah. Thank you.
More questions?
Can you show the stress grades around the recent crisis? I imagine you test against other crises in some sense. How this performs as a early warning signal? Because of course, in one case,
Sure.
did it work? Does it work also for other?
Yeah, I mean, we have, it's what stress grades really is. It's just volatility.
Sure.
This is, it's volatility estimetry. So you can, in a way, use all the research that's been done in volatility. There's nothing. It's using, it is simply putting names on, existing components and putting them together for stress testing, right? So every study that you know about volatility, whether that's been useful or not, that's it, right? And then, what I'm now experimenting with and meeting some people in Berlin actually on Friday is around extreme value theory, and to see how we can improve the forecast, with that, as well as opposed to, using the normal distribution. But again, my point really isn't that I want to forecast risk. I want to just That's the reason I never felt uncomfortable about using the normal distribution, because my whole point is I want to sense when something abnormal is going on, right? Yeah, that's point me to studies if you find any that are interesting, please.
Okay, thanks, Alan. I think if we have no more questions, we can move to the second part.
Okay. Sure.
And then we have a break after that.
Great. Sounds good. Cool. 20 minutes? Yeah. Yeah. For this next one. Yeah. Okay. Good. All right. So I'm going to set the timer now. Can we have the second presentation, please? Okay. So I'll just introduce the second presentation. Essentially, we wanted to. I want to move here from measuring risk to managing risk, right? How can we actually, instead of just measuring and reporting risk, how can we more successfully manage risks? And there are really sort of two aspects that are related that I wanted to focus on here. The first is polarity management, right? And the second is that's the process by which we manage risk. Is actually the fundamental process of management, any kind of management, is polarity management. Okay? And then the framework for this I will call integral risk management. And integral refers to essentially something that's comprehensive, that's complete, right? And so there are a lot of valuable partial perspectives, right? But it's often difficult to see how do you integrate a qualitative and quantitative sensory. So those are the two things that I'll focus on in the next 20 minutes. Got the timer on here. Yeah. So I'd recommend get this book, Polarity Management. It's an old classic, right? And polarity is all around us. We live and breathe polarity, right? This is your breathing in, right? Breathing in and breathing out. What's better, breathing in or breathing out? No, they're opposites, right? What's better when all your breath is gone? At that point, it's better to breathe in. And when I breathe in, at that point, it's better to breathe out, right? There's no absolute one is better than the other. There's actually a healthy cycle. If you inhale and exhale in a healthy way, that leads to life. And if there's a mismatch, that leads to death. We see all sorts of polarities everywhere in the world. So think in your mind, and it's okay for you to prefer one or the other, right? But just think in your mind as I go through this list, which you prefer, right? And that can change. You prefer one at a certain time than something else at another time, right? So these are classic pairs, right? Individual and team. Autonomous or collaborative. Directive decisions or participative decisions. Centralized, decentralized, standardized, customized, left brain, right brain. Optimized, flexible. Short term, long term, tactical, strategic, macro, micro, independent risk management or embedded risk management. Right? And what's interesting is that they're polarities. And what a polarity is something that is an opposite, but an opposite where both have positive and negative attributes, right? A polarity is not good and evil, right? A polarity is something which has positive aspects. There are positive aspects to being an environment where there's a lot of individual autonomy, right? But there are also negative aspects of that if there's too much autonomy. There are positive aspects to being in collaborative environments, but also negative, right? And so finding interdependent opposites where both have positive and negative attributes. Okay. So the key thing is that risk management is not about problem solving, right? It's a continuous practice of managing polarities. The way we thought about it at JP Morgan was an example of centralized risk management and decentralized risk taking. Right? On a day-to-day basis, it was not our job as risk managers to tell some FX trader to, unwind the euro position or do something else, unless what that individual did started to affect the collective in a way where that became a central importance, right? So someone going long and short euro or buying, a corporate bond or selling a corporate bond is really of no consequence to the risk manager, the centralized risk manager, as long as the whole boat, as long as that position unit itself isn't so huge it threatens the whole, or many such positions have accumulated across the bank so that as an aggregate that tips the whole boat, right? So that's an example of that. And so it's really a practice of dynamically cycling through these periods, where sometimes the focus really is, you need to, really allow decentralization, right? And other times it's really about taking a centralized perspective, and that shifts dynamically, right? I'll say one thing, that integrating polarities is not blending information. That happens quite a lot. So, quite a few of the large banks have decided. For example, UBS had used 5 years of data for their VAR, right? And in their view, using short window of data, more data is always better than less data. Why wouldn't we look at more data, right? And if you look at more data, 5 years, you're more likely to get an extreme data point as well, right? So it makes sense as a risk estimate that we use more data, right? Well, that could or could not be true. It depends on how sort of you calibrate that and what the purpose is. If your VAR, if you're trying to use VAR as a long-term measure, right, and therefore making VAR better by having more data, I think you're missing the point of VAR. VAR is not a good long-term risk measure, and it's not a very good tail risk measure itself, right? VAR is actually a very good short-term risk measure, and as a short-term risk measure, you want to look at calibrating your model so that it forecasts risk the best, visible risk the best in the short term, right? So, in my view, it would be like, suddenly your heart starts beating like crazy and your blood pressure spikes up, and you go to the doctor and they measure you, and they go, oh, yeah, it looks like you have very high blood pressure and your heart's beating like crazy. But if we average that over the last 5 years, you're kind of okay, and it doesn't make sense, right? It's like VAR is literally you're taking the pulse of the information, right? And it's only good as a short-term measure of visible risk, right? We already know it doesn't measure visible risk, it doesn't measure tail risk, it doesn't measure long-term risk, right? And so that's an example. They tried to look short-term and long-term, and so both are valid. Let's blend it together. That's not polarity. Polarity measure, you're actually going, you have a really good short-term measure, you look at that, and then you look at risk from a long-term structural perspective. Right? You don't breathe in and out at the same time. Breathe in, and then you breathe out. So that's polarity. So I've got a few examples here, top down, bottom up. Right? Everything has positive and negative attributes like polarity. And typically we start at the positive at one pole, right? So this is top-down positive. You have a structural systemic view, you look at long-term macro factors. But if you just do that, then eventually the downside will manifest. You'll be out of sync with markets. It'll be theoretical, practical, rigid framework. And then naturally you then cycle to the positive of the other, and look at the bottom up. You act on specific localized knowledge, have fast autonomous decisions. But if you stay there too much, then eventually you become reactive, short-term oriented decisions, coordinated. Okay. So you do that right, you have good risk management. You do that poorly, your institution will fail. Then visible versus potential. If you just look at potential or invisible risks, right? You're constantly, you're forward-looking, you're constantly identifying hidden risks. You could consider potential extreme risks. But if you just do that, you'll be paralyzed. There'll be excessive risk aversion. You'll fail to prioritize immediate needs, right? And if you just consider the visible risks, right? It's very concrete, present-oriented. You manage the risks that matter right now to the market. But if you just do that, then you become too reactive to the current market environment, myopic, and you underestimate potential tail risks. Okay? Strategic, tactical, same idea, right? Positive, fundamental, big picture view. Downside, slow to respond to changing conditions. Then you go to tactical, positive, current view, concrete, quantifiable, dynamic, flexible, responsive, but downside, myopic, unable to view long-term opportunities, conventional, unimaginative, herd mentality, pro-cyclical, and trend follow. Okay? So that's an idea of how that flow works. I'd recommend a couple books that are related to this. First is Anti-Fragile by Nassim Taleb, who's quite controversial and so on. He's a perfect example of someone who actually expresses one polarity very well, but misses the other polarity. He's always positioning himself as a contrarian. I'm right, you guys are all wrong. And the way that modernity is all wrong, and and so on. But just look at it as he represents one side of the polarity, right? And people like that are very useful, right? It's very useful to have someone be at that one extreme. So just take it with that grain of salt. You don't have to like him, right? But he has some valuable things to say. So he talks about the concept anti-fragile, things that we gain from disorder as opposed to fragile, you're hurt by volatility. And he's not just talking about robustness or resilience, which doesn't get hurt very much by volatility. Actually something which gains from volatility. Because if you think about evolution, life, we gain from volatility. How did we evolve? Through volatility. How does the system get stronger? Through stressors, right? That we adapt to. So how can we create institutions that more resemble these ecosystems, right? That benefit at least some small volatility, right? Modernity often lowers volatility at the expense of fragility. Right? So an example is Nike running shoes, right? They found that the more money you spend on shoes, running shoes, the more likely you're going to get running injuries. Okay, and the reason is that if you have shoes that are expensive, they're well cushioned, right, and they're well supported, right. So your short-term risk goes down, right. You feel much more comfortable, but in the long run, you get much more vulnerable because your muscles atrophy. Right? Imagine you're in a cast. Has anyone broken a leg here? After you spend 6 weeks in a cast, right, then try to walk on it, you're pretty fragile at that point in time. Right? So stress, modernity often wants to just lower and lower volatility. Right now the euro is a perfect example of that. The euro lowered volatility in the short run, right? But what happened was that volatility didn't disappear just by saying, oh, we're going to now have a monetary union, but not have a centralized mechanism for fiscal discipline, etc., nor the desire to merge it as one entity, right? Just is pretending that the problem doesn't exist, right? That problem surfaces somewhere else. You see it all around managed currencies as well. The Thai baht, when it was a fixed currency fixed to the dollar, right? It didn't mean that it was equivalent to the dollar, right? It just meant that those risks were not visible. And so it's a real temptation to look at risk and volatility. Say volatility is bad because volatility is risk. We want to reduce risk, and then we reduce the visible risk, but at the expense of hidden risk that comes later when we don't know it. It's a very bad trade-off. Okay. So what's the value of risk? I actually, before I published that, I wrote started writing a little essay about, it shouldn't be value at risk, it should be the value of risk. Right? I think that before there's tremendous value in the market mechanism, market signal, right? If you get rid of that, right, mechanism, you are getting rid of information, right? You want information. When you run barefoot, right, and I don't know if you can't do that here in the winter, but there's a big trend, barefoot running. Buy the latest shoes now, also from Nike, right? They're basically Nike representatives visited Stanford University, where I actually went to school, and they sponsored the track team, and then they're like, we give you our most expensive, best shoes. Why do you guys run barefoot? The athletes train barefoot, right? To build robustness, resilience, anti-fragility, right? Because you're getting feedback from your system learns, right, from risk. Volatility and stressors are information, actually, right? Not all information. Some is just random, right? But there's some information volatility, right? And stressors strengthen the system, right? So Nassim Taleb has this example of, he's now upset so many people that he's gotten all these death threats. He's decided he needs to get really strong. So he hired a bodyguard who's like this really big guy. And what this guy does as his workout is he lifts the heaviest weight he can at one time, right? And what happens naturally to your body, if you stress it, if you lift 50 kilos, your body goes, oh, I better be prepared to lift not just 50, but maybe 60. Then you lift 60 kilos, and the body goes, so your body overcompensates. There's a natural anti-fragility in the system, right? So it strengthens the system. So in other words, as a central bank, for example, you don't want to over-coddle and over-control volatility, right? But at the same time, too much stress will break any system, right? So, it's like when you have a child, of course, if they're about to stick their fingers into electric socket, you don't go, oh, they'll learn from that stress. No. Prevent them, but you will hurt them if you try to prevent them from exploring their environment completely. Okay? So there's a J-curve effect. Small risks, many small volatility benefit the system, create anti-fragility, whereas big movements hurt. Right? And then, as a complement, I would read Signal and Noise by Nate Silver. And interesting, I looked at Amazon. Amazon's already detected that if you go to one of those books and say, oh, people who bought that book usually bought this book as well. So this Signal and Noise is the perfect polar antidote to Nassim Taleb. Okay? And it's a good book. Many great lessons in that book, so read it. But one example he had was the fox and the hedgehog, which comes from an ancient legend. Right? There's the hedgehog, who when faced with stress does one thing, he curls up into a little thing. Right? He gets one item. And then there's the fox who always has like tries different things. Run around, go into a hole, and the fox will try anything. Right? And so what they found is that people are either foxes and hedgehogs. Right? Hedgehogs are ideologues who believe they have one big idea. And interestingly, that's Nassim Taleb. He's a hedgehog. He's got one big idea. It's his concept of this process of anti-fragility and black swan. One big idea. And then there's these foxes who are always coming up with new ideas and tinkering. Someone like a Steve Jobs, for example, is much more of a classical fox. But in terms of predictors, and Nate Silver talks about that. Basically, the ideologues do pretty bad at predicting, right? Because they don't adjust. They consider too few factors. They don't adjust their worldview. Whereas foxes make better predictors. So they have very overconfidence. They need to do information. More minds can improve forecasts. Right? So if you average analyst expectations, right, they're better than usually any single analyst. Okay. All right. So 4 minutes left. Integral risk management. Okay. So essentially, there's always this debate: qualitative and quantitative. What's going on? So here, what do you see here? What's that?
Duck.
A rabbit?
Duck.
Yeah. Right. Exactly. How about here? Right. So it's like, who's right? Is it a rabbit? Is it a rabbit? Or is it a duck? Who's right?
It's a rabbit.
You're both right, right? But it's a partial truth, right? So the concept of integral really is how do you integrate perspectives. And I would recommend reading Ken Wilber. Here's one of his books, Brief History of Everything. I'm sure it's translated to Russian as well. And he really wanted to kind of figure out what are the key dimensions that you integrate. Okay? So he came up with this framework called AQUA, all quadrants, all levels, and lines that I introduced here. In terms of a risk perspective, really what that says, it says at minimum, you need to consider 4 perspectives, at minimum. And that is that everything has an objective exterior and a subjective interior, right? Everything can be viewed as one or many, individual and collective, right? From a risk perspective, right? So objective exterior, that's the science, right? So of course you need good metrics, good measures, good data, right? But if you just have a spreadsheet, someone with a spreadsheet somewhere, and don't have systems, processes, governance, structures in place, right? You're not going to have a good system. But even with the best systems and data and analytics, if you don't have individuals, right, with the right integrity, expertise, confidence, ability to question, right, you don't have these risk managers, you will not have a good risk process. And finally, if you don't have that collective interior culture, right, where you're sharing, you have a shared vision, shared values, and a culture of risk management, then you will succeed. Right? And interestingly, the only thing that survives in a company, right, that grows in a company is this culture, right? The individuals come and go, right? There's always more data, of course you need that. There's systems always change, right? That is generic. Everyone can have that, right? What stays unique, what stays in what stays and what grows, the only thing that grows organically in a company is not individuals, it's culture, it's crucial. So those main four perspectives is it is singular exterior, you can say it's plural, but that's basically the raw science, right? And the interior is, I is individual, we is collective. So in philosophy, those are called the big three: the good, the true, and the beautiful, right? The true, science, you can verify, measure, right? The beautiful, I, inside, right? Like, meaning art is in the eye of the beholder, right? I might say that this is a really great logo for the firm, but someone else might not think that. It's an individual interior decision, right? And then there's we, right? And that's the good, right? That's morality, right? What we collectively decide, right? Subjectively decide. Right? So that's how it relates to the philosophical free. So in terms of culture, right? I mentioned the importance there. What's the biggest threat to culture? 20 minutes, I'll wrap up now. I think the biggest challenge is really groupthink, right? It's like you need to create a culture where there's enough diversification and diversity in there that is not hijacked and dominated by a few perspectives, because otherwise you're not benefiting from it. So you want to assemble a team with multiple intelligences, right? You want to focus on some individual work as well, right? This is interesting work from Tony Schwartz, who has the Energy Project. He gave an interesting talk at Google. You can just check the YouTube on that. And it's talking about how you can create peak performance. He studied top athletes, right? And as experts in polarity management now, you'll see what the key polarities are here. High and low energy, right? Positive and negative mental states. What he's talking about is that you need to go, that most people spend a lot of time there in the survival zone. High energy, but stressed, negative, right? And then you go from high energy stressed to burnout, right? And you have that cycle. Top athletes, they will cycle from a high energy, energetic, challenge, flow, positive mental state to recovery. Okay, positive recovery to rest, back and forth. So the polarities here are activity and rest, right? And there is a positive and negative aspect to polarity. The key stages to risk management here, generally, it starts off in terms of we call it intuitive or subjective, right? It's based on just some individual. Then predict and control, objective, structured, top-down, measures-based. And then you go to sense and respond, integral, network-based. Right? And so those are universal stages of growth for individuals and organizations as well. Okay? And so how we learn, actually, the key thing is we need to learn as organizations. So this learning spiral is driven by continuous differentiation and reintegration. So let's look at micro, right? So we take a macro, big picture, holistic ecosystem view, aware of interdependence, right? We understand what the key early warning indicators are for the downside, too theoretical, ignores reality. And we move over to micro, agile, quick to respond to change, highly focused, fast decisions, learning through feedback and data. Early warning, if you spend too much time there, over-focus, missing the big picture, reactive, short-term, coordinated, isolated, and then back. Okay. So we have integral risk management from running cycle well, and we have fragmented risk breakdown. So in summary, this is the structure that there are macro risks, which are potential invisible risks, micro risks, visible, right? Typically these invisible risks are more long-term, the visible risks are more short-term, right? So, you know, you have a tactical strategic portfolio construction. Strategic, you focus more on the potential long-term risks. Tactical, you want to take into account more of that short-term market environment. You want to set up an early warning system where you look at short-term outliers, right? And then you want to determine, does this outlier mean that you have actually a regime shift, which means that you have long-term risk. That's that overall flow. And so what you need for analyzing macro risk is, again, thought leadership, right? So imagination, right? Ultimately, not just people who know history, but imagination. And then for micro risk, the visible risk, we have, as quantitative risk, we have the most amazing connected distributed cloud computer that's ever been created, that everyone has access to in the entire world, right? So there's a tremendous amount to learn from there. Okay, so key lessons and conclusions. First, check out this book here, Expected Returns, and it demonstrates how you can, by consistently being contrarian in a disciplined way, extract value in investment strategies, right? That basically the future reward for risk may be the highest when the market sentiment for taking risk is the lowest, as we saw before. The biggest pitfall in investments is herd behavior. Large gains in performance can be achieved by investors with the ability to consistently act. Contrarian. Okay? We're all interconnected, right? Last year, you know, one slab of ice, you know, this big, killed a bunch of people. Top climber, you know, released a block of ice. We're all together in this, right? We're very tightly coupled as a globe. So we're going to have to prepare for some breakdowns, right? We're going to have to try to decouple some of these risks, right? But there will be some systemic breakdowns as well that we need to be agile and prepare for, right? The World Economic Forum, interestingly, is one of the key focuses is now on resilience, right? And looking at things from a systemic perspective, not just maintaining the system function in the event of disturbance, but the ability to withstand and recover and reorganize. Okay. So check out the Global Risk 2013 report. There's quite some useful things. And one thing they're trying to do is promote network intelligence through resilience practice exchange. Right? So that's my main point. Is that really we can do a lot by essentially building collaboration platforms. Right? This is an era of building mass collaboration platforms. Right? Facebook's done. Right? There's so much potential in basically building collaboration platforms to exchange risk information. Okay. Yeah, that's basically it. Adaptive risk management, learn clarity management, sense and respond, build social collaboration platforms, real-time analytics, data visualizations. A lot of advantage out of predictive markets and proactive global action, right? So, what Alan Greenspan used to say about bubbles is, yes, bubbles exist, but it's easier to mop up the mess afterwards than to try to predict them. That's not an option that we have for systemic risk. That's not risk management. You don't wait until you have a heart attack to change your diet and exercise and things like that. You need to do that. You're going to get a much bigger gain on investment before. Encourage diversification, decoupling at all levels, sharing investment strategies to counter-cyclical capital allocation and monetary policy. And we have a responsibility as risk managers and as humans to protect not just our institutions but our whole ecosystems. Right? So thank you.